Now that the world's attention is on distribution of metal, what does China do? Reuters headline, Inside China's bid to build sway over global metals pricing. Another story we've been following quite literally for years here, with the LME pricing and this slow motion move, almost I want to call it this magnetic or gravitational pull of the pricing of metals towards China. Very interesting. Hello and welcome to the Northern Miner Podcast. My name is Adrian Pocobelli, and it continues. Every week, a new dimension, a new chapter in this fascinating, metals story that seems to incorporate so much of what's going on in the world, yet, still a story here and a story there in the New York Times, FT, Washington Post. But considering the central role that these metals play, you could argue still surprisingly ignored, I would argue, but not here, which is why I hope you listen to this show. So let's take a look at this article. Again, this is Reuters, Inside China's bid to build sway over global metals pricing. This came out on October 14th, yesterday. China is locking in steps to shape the pricing of the vast quantities of industrial metals it produces and consumes, with moves to attract foreign firms to trade on Shanghai's futures exchange, which would eventually fragment global markets. After buying mining assets around the world over the past 2 decades to secure metals needed for industrialization, and more recently to meet its carbon emissions targets, China now wants a bigger say in how prices of those metals are determined. Now, of course, most of those industrial metals are priced on the London Metal Exchange, also known as the LME. But as we've noted in previous episodes going back 6 months to a year, if not longer, the LME, of course, is owned by Hong Kong exchanges and clearing. So interestingly, the Shanghai Futures Exchange, their main competition, is actually owned by Hong Kong exchanges and clearing, which is worth noting. Again, you don't really hear too many questions really raised about the fact that the LME is owned by Hong Kong exchanges and clearing. But I think you have to keep that in the back of your head as you're reading this story. And as I noted, it's probably a year and a half ago. It was in my last apartment, and I've been here for over a year now. Maybe like a year and a half, 2 years. It may not seem like a big deal in the West. Again, it's not really on page one whether metal prices are determined in London or in Shanghai. But I would argue, I suspect, and pure speculation over here, I suspect this is a massive deal if China can determine pricing of metals in their home country. They have shown a real interest in metals in the last 20 years, scooping up assets, and imagine it was you. Would you not want, to finish the coup de grace, so to speak, to get the pricing done in your country rather than the West? And let's not forget the century of humiliation. Let's not forget the Opium Wars. With that history, do you want to continue getting your prices out of London? And I think the answer is no. And as I mentioned, a year and a half, 2 years ago, again, this may not seem like a big deal to many, mainstream news editors in the West. But from a Chinese perspective, I would think this is a major milestone in the transference of economic power from West to East. That is what I dare say is looming at the back of the mind of many of the administrators in China who are pushing for this. Otherwise, why would they care? Or why would the West care? Of course you want to have the pricing. It is symbolic of economic power. It has meaning. Now let's go back to our article to see what it says. So China now wants a bigger say in how prices of those metals are determined. But China has lost market share in metals future trading and needs to persuade international investors to use the Shanghai Futures Exchange, or SHFE, according to interviews with more than 10 brokers, traders, analysts, risk managers, and consultants with direct knowledge of SHFE's plans. If successful, the push would help give Shanghai's contracts benchmark status and upend the system for reference prices of industrial metals in place since 1877, when the London Metal Exchange, LME, started life above a hat shop in London. It seems to even take us back to the time of the Opium Wars. When were the Opium Wars? 1839 to 1842 and 1856 to 1860. And this was part of the Century of Humiliation. And we've heard Xi Jinping mention the Century of Humiliation many times. So do you think President Xi, it matters if he'd take it or leave it with all of the interest that China has shown in natural resources? So let's continue here. SHFE benchmarks would eliminate the need for Chinese firms to link their physical contracts to LME prices and create a need for foreigners to trade on SHFE to influence reference prices in their contracts, shifting market sway from the West to China. And you could also see this potentially as a form of resilience from a geopolitical perspective, as we saw with Russia being cut out of SWIFT by the West. Perhaps in its own way, determining pricing in China is a form of resilience in the sense that you are no longer relying on a potential foe should, for example, Taiwan, let's say, become an issue. Let's continue. In recent meetings, the exchange told industry players the plan is high on its agenda and was likely to be put in place soon, but it did not discuss deadlines, two people said. Shanghai Futures Exchange did not respond to requests for comment or to question on timelines, amounts available to invest in this project, the challenges it faces, or how success would be measured. However, state media in June reported Wang Fenghai, general managers at Shanghai Futures Exchange, as saying, quote, only through opening up can we draw in foreign investors, participate in the process of Shanghai Futures Exchange's price establishment, therefore enhance price influence, end quote. Wang added that cross-border delivery capability was an area SHFE would focus on in terms of attracting global participation. In a key step, the exchange has been looking to line up warehouses outside China to store metal delivered for copper contracts that were launched on its International Energy Exchange, INE, for foreigners in 2020. SHFE has told industry stakeholders it intends to expand soon into international metal storage. Two other sources with direct knowledge said, bidding to rival the LME's global network of more than 450 registered warehouses that hold thousands of tons of aluminum, copper, and other metals. And we have a quote from an anonymous source familiar with the exchange's thinking, who said, quote, they, referring to the SHFE, they have a plan. They are coming out. They will list warehouses outside China. The government wants this to happen. End quote. While the metals industry has known since last year that SHFE plans to line up warehouses offshore, starting in Singapore, its latest comments to foreign firms suggest it is closer than ever to going ahead. And here's a quote from a source at a consultancy with knowledge of SHFE's plans, who said, quote, a real price people want to use needs warehouse stocks the world over, end quote. Once SHFE makes a firm decision to offer metal storage outside China, the process of registering warehouses would be a matter of weeks, if not days, as facilities already exist at ports that see large flows of metals, warehousing sources said. SHFE will not need regulatory approvals for warehouses that can store metal deliverables against its contracts as long as they are located in free trade zones, so metal can be stored free of taxes until delivered to customers. Singapore makes a good starting point as it is already a location for LME warehouses, which means the regulatory framework already exists. All of the people who spoke to Reuters asked not to be named as their conversations with SHFE were private. Super interesting. And it continues. The Shanghai Exchange faces a difficult road countering the LME, even as China consumes more than half of global supplies of copper, aluminum, and zinc, and produces large amounts of these metals. And here's a quote from Luo Zhufang, chairman of Nanhua Futures, who told Reuters, quote, any exchange that wants to achieve internationalization would face challenges. SHFE would face many challenges and various constraints if it aims to become a global pricing center, end quote. The article continues, ultimately the exchange aims to list aluminum, zinc, nickel, lead, and tin on the INE, which was that energy exchange, sources with knowledge of SHFE's plans said. Those metals are already traded on the LME, the world's largest forum for metals owned by Hong Kong Exchanges and Clearing. On the LME, volumes for copper, essential in construction, power systems, and electrical goods have stabilized at around 60% of copper futures globally. But SHFE's domestic market has lost ground to US-based COMEX, part of CME Group, since 2015, with SHFE last year accounting for around 15% of copper futures traded globally, while COMEX's share was 22%. And in the first 9 months of 2024, trading volumes on SHFE's INE copper futures have dropped nearly 43% from the same period last year. And here's a quote from a metals trader, quote, "The only way to increase volumes is to get more international involvement in SHFE," end quote, a metals trader with direct knowledge of the matter said, adding that China's government was behind the project to internationalize SHFE's contracts. The China Securities Regulatory Commission, CSRC, which regulates SHFE, and the State Council, China's cabinet, did not respond to questions from Reuters. Meanwhile, LME is working on plans to list new contracts using SHFE prices and is set to approve the expansion of its metals warehousing network into Hong Kong before the end of this year. Now, those were the stories I was referring to from over a year ago. And let me repeat that line. Meanwhile, LME is working on plans to list new contracts using Shanghai Futures Exchange prices, which is something that they wanted to do and were arguing for, and is set to approve the expansion of its metals warehousing network into Hong Kong. Another story that we noted on this program, and that will happen before the end of this year. LME said it intends to, quote, "deepen our collaboration with SHFE, Shanghai Futures Exchange, by working together in product innovation to better serve international participants in risk management and price discovery," end quote, in response to a request for comment on its plans. Now, if one were to be a little bit paranoid about it, one might ask, what on earth is the LME doing sharing all of its pricing, product innovation with the geopolitical competition? Just an open question here. And I remember a year and a half ago asking a similar question, like, whose side are these guys on? And don't forget, who owns the LME? Hong Kong Exchanges and Clearing. So let's finish the article, because I think this is a showstopper here. SHFE's ambition has been long in the making. When Hong Kong Exchanges and Clearing bought the London Exchange in 2012, with a plan to turbocharge revenues by expanding LME warehousing into China, Shanghai Futures Exchange told local authorities it would mimic the LME's network and give China power and influence over global metals markets. Some of that influence would come from more foreigners trading on SHFE, having to hold yuan accounts, which would boost Beijing's aim to gain global acceptance of its currency. Contracts on SHFE and its INE platforms are priced in yuan. Quote, "SHFE has been trying to do this for over 10 years, end quote, said Dan Smith, head of research at Amalgamated Metal Trading. He continues, quote, "The biggest challenge is that there are still restrictions on the conversion of yuan to dollars," end quote. Finally, China's currency exchange controls that limit the amount of money companies can take out of the country at any one time, partly a measure of control currency volatility, are potential deterrents for foreign investors. Sources also mention fear of Chinese authorities' policies designed to steer commodities markets and government market interventions, such as margin requirements, the deposits of cash or collateral clearinghouses need to cover potential losses. Quote, "They don't like volatility. They could double, triple transaction fees and margins overnight if they want. It makes people nervous," end quote, a source familiar with the matter at a resources-focused fund said. So that is your article here. And again, it only makes too much sense for China to want to control the pricing. Does it not? So a huge story there. The kind of story we love to focus on this program. So a great show ahead of us before we look at some of our other stories here. We have Kevin Fox, who is a geologist, now consultant and ex-Rio Tinto employee, helped lead a team make a diamond discovery in Zimbabwe, and has worked all over the world. So we're going to talk to Kevin Fox today for the first time on the Northern Miner podcast and hear his big picture views of some of the main themes that are driving the narrative in this industry. So that should be fascinating. Now let's just continue here with a few more headlines. As you may have heard, President Biden has delayed his trip to Germany and Angola. And there is a statement from Secretary Karine Jean-Pierre from the White House website. Given the projected trajectory and strength of Hurricane Milton, President Biden is postponing his upcoming trip to Germany and Angola in order to oversee preparations for and response to Hurricane Milton, in addition to the ongoing response to the impacts of Hurricane Helene across the southeast. So the trip to Angola, celebrating the Libido Corridor, has been delayed, but it sounds like it's still going to happen. However, I also mentioned last week Jose Fernandez, the Undersecretary for Economic Growth, Energy, and the Environment at the U.S. Department of State, who is going to Portugal. And we do have an update on that. This is also Reuters via mining.com. China is oversupplying lithium to eliminate rivals, U.S. official says. Chinese lithium producers are flooding the global market with the critical metal and causing a, quote, predatory price drop as they seek to eliminate competing projects, a senior U.S. official said on a visit to Portugal that has ample lithium reserves. Now, interestingly, I was speculating perhaps part of the reason that Jose Fernandez was there was actually to have a welcoming point for the copper leaving Angola on the western side of the African continent. Where could it go that might be easier? I was speculating maybe that's why he's in Portugal, but apparently there are ample lithium reserves in Portugal. Let's continue with the story. Jose Fernandez, Undersecretary for Economic Growth, Energy, and the Environment at the U.S. Department of State, told a briefing late on Monday that China was producing much more lithium, quote, than the world needs today by far, end quote. He continues, quote, that is an intentional response by the People's Republic of China to what we are trying to do, end quote, with the Inflation Reduction Act, the largest climate and energy investment package in U.S. history, valued at over $400 billion, Fernandez said, adding, quote, they engage in predatory pricing, they lower the price until competition disappears. This is what is happening, end quote. Now, as I've long said here, I think there's an easy solution to this issue, which is if you have $400 billion that you're going to spend on the IRA, why not put $40 billion of that towards stockpiling and you're going to own the entire metals market? I mean, I think you'll be able to fix the predatory pricing without having to do anything other than stockpile and have a bunch of lithium on hand. So do what the Chinese do, which is when cobalt drops, they are stockpiling right now. If that's the issue, then simply buy it, right? I assume it's not difficult to store. Perhaps that's the issue. Let's continue. China accounts for about 2/3 of the world's lithium chemical output, which is mainly used in battery technologies, including for electric cars. Prices of lithium have fallen more than 80% in the past year, largely due to overproduction from China and a drop in demand for electric vehicles. However, the price collapse is also affecting China as it has forced Chinese companies like battery giant CATL to suspend production at certain mines. Fernandez continued and said the low price, quote, constrains our ability to diversify our supply chains on a broad global scale, end quote, and also hurts countries such as Portugal that need investment to develop these industries. Portugal, with some 60,000 tons of known reserves, is already Europe's biggest producer of lithium, traditionally mined for ceramics. Fernandez also said, quote, we want to help them, referring to Portugal, and we think we can. Lithium mining companies everywhere have to survive this difficult phase that was created by predatory pricing, end quote. So interesting story there. And just a quick article here on the Northern Miner as well that I wanted to note. There's this infographic adding up government spending on Quebec's critical minerals. And this is in Quebec. And so just to give you a clue as to how much money, very interesting infographic here on the Northern Miner. The top minerals spending, projects with the most funding in Canadian dollars in Quebec is lithium with $332 million Canadian. So we're talking maybe $225 million US. The next largest is graphite with $53 million, nickel with $9 million, and then vanadium, $5 million, rare earths, $5 million, copper, $2 million, and others, $1.4 million. And it also has top government spenders, with the government of Quebec making up $385 million of those dollars. So most of what we saw there. And the Canadian government making up $12 million, and the U.S. Department of Defense contributing $11 million to these projects. So quite interesting to see that kind of spending. I mean, we're talking not even $500 million in contrast to the $400 billion IRA, just as a mark of contrast. And just on the electric car front, we have a few headlines here that I want to touch on. Stellantis-backed Leapmotor, which is a Chinese-based company, unveils B10 or B10 SUV to be sold globally and priced between $14,000 and $21,000. So you will soon be able to get an SUV from joint venture partners Stellantis and Leapmotor for as low as $14,000. So it just increasingly seems if Western car makers want to compete, they have to be partnered with China. Another headline, this is electric.co, BYD to break into Europe's largest auto market with EVs priced around $30,000. And also from Electric, October 11th, BYD tops SAIC to become China's largest auto group. Now, if you're wondering who SAIC is another joint venture between a Chinese company and leading global automakers, in this case, Volkswagen and GM. And last month, so the month of September, BYD has topped SAIC in September sales. And that is in China. BYD increased their sales by 45% from last September's numbers. Meanwhile, SAIC is struggling to keep pace. Its joint venture with GM, SAIC GM Wuling, is a big reason as sales collapsed 35% in September. And through September, SAIC has sold 21.5% less year-on-year in China, falling behind BYD, while BYD has increased 32% year-on-year through September. So if you're wondering why Volkswagen is closing plants, one suspects it's not unrelated. Finally, also electric, China debuts a record-smashing 26-megawatt offshore wind turbine. This doesn't look like anything like your traditional wind turbine. It's basically a big rectangle with a circular front. You don't even see the blade. And this thing is the new release from China's Dongfeng Electric Corporation. And it is the world's largest wind turbine in both capacity and size, according to Michelle Lewis at Electric. So, a fascinating setup here, as usual. China dominating the minerals discussion. It's going to be interesting to see where things go. And of course, I talked to Kevin Fox about many of these huge themes facing this industry and this world. If you want to find us online, you can find us at northernminer.com. You can find us on X at Northern Miner, and on Instagram at The Northern Miner, and on Facebook, LinkedIn, and YouTube, where we also host these podcasts, and wherever podcasts are available, including Spotify, SoundCloud, and Apple Podcasts. And with that, let's turn to the news. Turning to the website, Rio pays premium multiple for Arcadium in biggest deal since 2007. This is by Frick Ells and Cecilia Jamasmi at mining.com. Rio Tinto will acquire Arcadium Lithium in an all-cash transaction, valuing the latter at $6.7 billion, the Anglo-Australian giant confirmed on Wednesday. Rio Tinto will acquire the United States-based lithium producer for $5.85 per share. It said the deal represents a premium of 90% to Arcadium's closing price of $3.08 per share on October 4th and is expected to close mid-2025. The move would position Rio Tinto as one of the world's largest lithium miners, behind only US-based Albemarle and Chile's SQM. The acquisition would hand Rio lithium mines in Argentina and Australia, as well as processing facilities in the United States, China, Japan, and the UK. Its customer base would include major names such as Tesla, BMW, and General Motors. The falling market prompted Rio to act, Chief Executive Officer Jakob Stausholm told Reuters, seeing the downturn as an opportunity to pick up top-quality assets at the right price. Quote, "We really want battery-grade lithium, that is, the processing as well. And then, of course, we would like to be an operator, and if you have those criteria, you very quickly come to Arcadium," end quote, he said. He continued, "The way you should think about it is kind of a reverse takeover. This is not a case about cutting costs. This is a case about building faster and better," end quote, Stausholm told Reuters. Arcadium chairman Peter Coleman said Rio would be able to bring its expertise in execution and a strong balance sheet to help develop Arcadium's assets. Quote, "They are not capital constrained. For us, we know that growth plans still relied on an improvement in price over the next 2 to 3 years, which is quite a significant improvement over where we are now," end quote, he told Reuters. And Jakob Stausholm told Bloomberg in a phone interview, quote, "The reality is that Rio really hasn't grown in a decade, but now we're back," end quote. The miner began more seriously considering options at the start of the year, looking, quote, at basically all the lithium projects around the world, end quote, Stausholm said. I remember over a year ago where Stausholm was saying we're not going to overpay for lithium, and that was before the big crash. So to Stausholm's credit, the patience seems to have paid off in terms of value for money. Let's continue. For Rio, with a market capitalization of $112 billion, Arcadium is seen as a bolt-on deal. It's still a test of the miner's deal-making mettle in a new era of constrained spending, as the biggest acquisition since Rio's $38 billion all-cash acquisition of Alcan in 2007. That purchase, after a bidding war, ultimately left Rio with $29 billion in charges. Quote, Alcan, in hindsight, was bought at the top of the cycle, end quote, Stausholm said. Quote, we feel quite comfortable that we have not bought a lithium company at the top of the cycle right now. We had to pay a fair price, and that's what we're paying, end quote. He also said, quote, it was a huge piece of work, but what became very clear to us was we would like to have exposure to brines. End quote, Stausholm told Bloomberg, adding Arcadium produces battery-grade lithium from direct extraction. And we have another story from Reuters. Rio Tinto's real prize, Arcadium's lithium extraction technology. Very interesting. And it says, Rio Tinto's $6.7 billion buyout of Arcadium will give it a suite of lithium filtration technologies that are poised to revolutionize how the metal is produced for the electronics and electric vehicle industries. Arcadium's expertise in so-called direct lithium extraction, DLE, is the real prize for Rio, analysts said, and vaults it into contention with Aramet, Sunresin, ExxonMobil, and others aiming to make the technology commonplace in coming years. The DLE industry is expected to grow to more than $10 billion in annual revenue within the next decade by supplying lithium for EV batteries in hours or days, not months or longer as with existing large water-intensive evaporation ponds and open-pit mines. While DLE technologies vary, they are comparable to filtration used by common household water softeners and aim to extract about 90% or more of the lithium from brines, compared to about 50% using ponds. No one has launched a commercial DLE operation without ponds, although multiple companies are racing to be first. Arcadium, through a predecessor company, was the first to develop an early version of a DLE technology in the 1990s at an Argentina lithium brine site that is still operational today. And here is Jakob Stausholm, CEO of Rio Tinto again, who told investors on Wednesday after announcing the all-cash deal, quote, DLE is actually the solution to provide the lithium that the world needs, end quote. He also said, quote, there's a lot ahead of us and we haven't explored it fully, yet it's the right technology, end quote. And finally, Chris Berry, an independent lithium industry consultant, told Reuters, quote, Rio Tinto is paying a premium for Arcadium in part for its intellectual property around DLE technology, end quote. And finally, Eric Norris, head of Albemarle's energy storage business and a former executive at an Arcadium predecessor company, told Reuters earlier this year, quote, DLE is about being a chemical processing expert. Companies like Arcadium, Albemarle, SQM, they have a lot of expertise that they can put to work in that area, end quote. So direct lithium extraction, DLE, a key component of this deal, according to analysts. Continuing on, Zijin Mining buys Newmont's Ghana gold project for $1 billion. This is Reuters via mining.com. China's Zijin Mining Group will buy the Akyem gold mine project in Ghana from U.S.-based Newmont Corporation for $1 billion, the company said on Wednesday. The sale is part of Newmont's ongoing program to divest non-core assets as the company makes a strategic shift to focus on its Tier 1 assets, the U.S. gold producer said. Newmont is expected to receive cash consideration of $900 million upon the deal's closure, with a further $100 million upon satisfaction of certain conditions. And Zijin said in a statement, quote, after study, the company is on the view that under the current and anticipate future gold price conditions, the project's utilizable resources and reserves still have significant potential. So, interesting there. Continuing in Africa, Mali seeks $500 million in outstanding taxes and dividends from Barrick. So, that mine that Newmont sold just went for $1 billion. Now Mali is seeking an extra $500 million from Barrick after the arrest and release of 4 Barrick employees last week. This is by a staff writer at mining.com. Mali's military government is seeking at least $512 million in outstanding taxes and dividends from Barrick Gold, according to a Reuters report. Authorities in Mali briefly detained 4 Malian staff members working for Barrick last month. On September 30th, Barrick stated it had agreed with the government to resolve existing claims and disputes. The demands on Barrick follow an audit of mining contracts last year and a subsequent push by Mali to renegotiate agreements with mining firms, including B2Gold, Resolute Mining, and Allied Gold, to channel greater share of revenues into state coffers under a new mining code. Under the new code, the percentage of Malian state and private interest in projects could rise from 20% to 35%. The law also aims to reduce tax breaks and increase the number of Malians in management roles. When asked to comment, a spokesperson for Barrick said, quote, "We are still in the process of negotiation and will let you know once the agreement is settled," end quote. Interesting there. And moving to Central Africa here, the Democratic Republic of Congo wants to pivot away from China's dominance over its mining. This is Bloomberg News via mining.com. Democratic Republic of Congo's top mining official said the country is courting new investors for its world-class deposits of key metals as it looks to diversify ownership in its industry, which is currently dominated by China. The plan includes streamlining processes to pay customs and taxes, along with a partnership with the United Arab Emirates, Mines Minister Kizito Pakabomba said in an interview. The nation is also planning to revamp a railway that can be used to transport minerals so cargoes can be more easily exported from a port along the Atlantic Ocean, positioned closer to U.S. and European markets, he said. Congo wants to, quote, "attract better investors, more investors, and diversified investors," end quote, Pakabomba said. The ambitions come as the country continues to play a key role in international metals markets, while also finding itself at the center of a contest between China, the U.S., and other countries vying for access to critical minerals. Congo recently overtook Peru to become the second largest producer of copper and is by far the world's biggest source of cobalt. Both commodities are key to the global energy transition. Continuing in Congo, Jeka Mines announces first germanium exports to Europe. This is Reuters via mining.com. Democratic Republic of Congo state miner Jeka Mines said on Monday it will ship for the first time germanium concentrates to Europe from its Big Hill tailings dump. The concentrates, made in a new plant in the mining hub of Lubumbashi, will be shipped to Umicore in Belgium for further processing and use in high-tech applications, Jeka Mines said in a statement. And here is a quote from Jeka Mines chairman Robert Lukama, who said in a statement, quote, "This inaugural shipment of germanium confirms our ambition, nurtured over several years, to make Congo a global hub for strategic metals." And of course, it was only a few months ago that China was starting to put export controls on its germanium as well as its gallium exports. So interesting move there. Continuing on, at least 20 killed in armed attack on miners in Pakistan. This is by staff at the Northern Miner. At least 20 miners were killed and 7 others injured after unidentified gunmen attacked a coal mine in Pakistan's southwestern province of Balochistan, according to police reports quoted by local media. The attack took place in the mineral-rich Duki district of Balochistan, a region that borders both Afghanistan and Iran. Barrick Gold's 50% owned Reko Diq copper gold project is located in Chagai district in the same province. The attackers stormed the miners' accommodations late Thursday night, rounded up the workers, and opened fire. Police officials said, according to the Express Tribune. They also fired rockets and grenades, damaging mining equipment before fleeing the scene. The assault has sparked widespread condemnation, with authorities launching a manhunt for the perpetrators. So far, no group has claimed responsibility for the attack, which is the deadliest in weeks. The violence comes just days before a major security summit in Pakistan's capital, Islamabad, and as the country hosts a Saudi delegation interested in mining investments. It also coincides with the signing of $2 billion worth of agreements between Saudi and Pakistani businessmen for investments in various sectors, including mining. And also, just a couple of lines here on this Bloomberg News story. Aluminum squeeze unravels on LME, easing pressure on sellers. So we've been kind of noting this story for the last, I want to say, couple of months here. A squeeze in the London aluminum market is drawing to a close, bringing relief to sellers who have been under pressure since a large buyer emerged. For months, the October aluminum contract has been a focal point for traders due to its steep premium to later-dated futures. Now with the contract set to expire on Wednesday, that premium has vanished after a wave of selling over the past 2 trading days. Continuing on, zinc facing supply deficit as mine output falls again. This is Reuters via mining.com. The global zinc market is facing a sizable supply deficit in 2024 as a raw materials squeeze forces smelters to reduce production of refined metal. A previously anticipated supply surplus of 56,000 metric tons has been updated to a 164,000 ton supply deficit. So from a surplus of 56,000 metric tons to a deficit of 164,000 tons. Mine production is now expected to fall for a 3rd consecutive year, and smelter treatment terms, a good indicator of raw material availability, have turned negative. So a bit of a supply crunch in the zinc market, interestingly. Continuing on, Cameco eyes expansions of uranium mines on rising nuclear demand. This is Bloomberg News via mining.com. Cameco, one of the world's top uranium producers, is considering expanding some of its mining projects as global demand for nuclear power rises, according to its top executive. And we have a quote from Chief Executive Officer Tim Gitzel, who said in an interview on Bloomberg Television, quote, "We've got some fantastic uranium ore bodies, and we're looking to extend and expand those where we can." End quote. And he also said growing demand for nuclear power poses, quote, "the best fundamentals I've ever seen for nuclear in my 40-year career." End quote. So interesting story there. So those are your news stories. Now let's take a look at metal prices. And turning to metal prices, let's take a quick look at the bond market for context. The U.S. 10-year bond is yielding 4.07%. That is 0.06% higher than last week. The UK 10-year gilt is yielding 4.2%, and that is unchanged from last week. The Italy 10-year bond is yielding 3.51%. That is 0.07% lower than last week. So US 10-year yielding higher, and the UK 10-year gilt unchanged, and Italy 10-year yield lower. Interestingly, turning to precious metals, gold is trading at $2,666.90 per ounce. That is $10 higher than last week. Silver is unchanged at $31.36 per ounce. Platinum is higher at $992.30 per ounce. That is $16 higher than last week, and palladium is trading at $1,019.50 per ounce. That is 50 cents lower than last week, so basically unchanged. Turning to industrial metals, copper is trading at $4.35 per pound. That is down 16 cents from last week, so copper taking a break. Iron ore is trading at $106.44 per metric ton, and that is $2 lower than last week. Aluminum is also lower at $1.18 per pound. That is 2 cents lower than last week. Lead is also lower at 94 cents per pound. That is 4 cents lower than last week. Nickel is also lower at $8.02 per pound. That is down 13 cents from last week. And tin is also lower at $15.07 per pound. That is down 26 cents from last week. And cobalt is unchanged at $11.02 per pound. Lithium is lower at $10.59 per kilogram. That is 17 cents lower than last week. Uranium is higher at $83.20 per pound. That is 70 cents higher than last week, so slightly higher. And zinc is lower at $1.40 per pound. That is 4 cents lower than last week. So metals drift sideways to lower. But no real drama here. When you see the metals all moving together, it would suggest that there is a macro factor, whether it's the dollar, the bond market, or just a lack of activity in general. Maybe a stasis period is happening here with all of the uncertainty around the U.S. election. And those are your metal prices. Coming up, I'm very pleased to welcome for the first time to the Northern Miner podcast, Kevin Fox, geologist, consultant, and ex-Rio Tinto employee with 40 years experience in the business, so an experienced and highly cultivated view on the big questions surrounding this industry. I hope you enjoy it, and I will see you on the other side. Joining us today, I'm very pleased to welcome for the first time to the Northern Miner podcast, Kevin Fox, independent consultant, geologist, and ex-Rio Tinto employee with over 40 years experience in the mining industry, based out of London. Kevin, welcome to the show.
Thank you very much, Adrian. Good to be here with you.
I love the perspective of the individual in this industry who's been in it and who has lived it. Nothing beats experience compared to, reading out of a textbook and whatnot. So I'm really delighted to have you here today. So before we get into what you're seeing out there, maybe for the audience, since it's the first time you're on the program, could you give us just a brief summary of your journey? Tell us how you got to where you are now.
Thanks, Adrian. I'm a geologist by background. I finished my degree in 1982 and moved almost immediately from Dublin to the Kalahari Desert, working in a large mining operation in Botswana. I did that for 2 years. It was a very useful first learning experience, but I recognized from the start that what I really wanted to do was exploration. So I moved from Botswana and working for Anglo-American to working for Rio Tinto in 1984 on a large uranium exploration program and production site in Namibia, the Rossing operation. And I stayed in exploration for the best part of the next 15 years in various parts of Africa, and was involved in a wide variety of exploration programs in different countries, different commodities, and different cultures and opportunities presented themselves to me during that time. I had some success in exploration discovery, which was probably one of the highlights of my career. I moved from Africa to South America in around 1998. And I started working initially in Brazil and then subsequently in Argentina in project development, which was a great change for me and an opportunity to really develop my management skills and project management in particular. And I think what really fundamentally got me excited about that was the opportunity to create value from a discovery of a mineral deposit. I've done that now in a couple of different projects in different commodities around the world, most recently on a lithium project in Argentina, again with Rio Tinto, and that was part of my last transition to M&A, and that was really, I suppose, a product of the fact that I had spent a long time looking at mineral deposits, operations, and exploration opportunities, and it gave me a perspective, I think, which was useful in the context of M&A. I retired from Rio Tinto in July 2022, and I've been working as an independent consultant since then with quite a broad variety of clients, with all of them obviously with an interest in investment in the mining industry. And I find that fascinating because it continues to give me quite a broad perspective, a range of perspectives on the industry and what's going on in it at the moment.
Well, I'm kind of excited to actually jump right into that. But before we get into what you're seeing at the moment, just to clarify on your history then, it sounded like to me that as far as this was a passion, it was the discovery element, finding new deposits. Just expand a little bit on what was so amazing about that before we get to what you're seeing now.
Sure. I mean, first and foremost, because it's so rare, so few geologists have the opportunity to participate in new mineral discoveries. It's tough, both technically and just the chances of success are relatively small. So to be involved in something that leads to a discovery and ultimately development into a mine is both very professionally rewarding, but in terms of, the teams you work with and the value created by discovery, it's just a tremendous thing to be participating in.
And can you say what you did discover?
It wasn't me, it's a team which I happened to lead at the time. And it was a diamond discovery in Zimbabwe and turned into the Maroa diamond mine, which, believe it or not, happened in 1993 and it is still in production, which is testament to the endurance of it and the quality of the products that came out of it. It resulted in the discovery in 1997 and the actual going into production in about 2000. So it's had a long history, but it was certainly one of the highlights of my career.
You are consulting now. What are you seeing? I mean, what is the sentiment out there? What are you observing?
I would say the first thing that I would point to is the much higher profile the industry has got now, perhaps in particular because of its relevance to the energy transition and the ability of the industry to contribute to what's now being referred to quite often as critical minerals and the importance of those in fulfilling the objectives of the energy transition. When I joined the industry in the 1980s, it was pretty much a slow moving and not terribly visible industry that was just humming along in the background. I think in the past 5 to 10 years in particular, that profile has changed enormously. And the frustration I sometimes feel with the industry is firstly that it doesn't tell its story well enough and underlines its importance and need in not just the energy transition, but in supplying basic materials for development, etc. The second point I would make about it is that I think the industry has suffered in the past from an overabundance of short-term thinking and without sufficient attention to long-term strategic thinking. And, if we were to talk about the current situation with respect to supply of critical minerals, for example, I would suggest that quite a lot of the deficiencies that are around at the moment have been a result of lack of commitment to long-term thinking and strategic thinking. That is changing now, and I'm starting to see that in quite a few of the calls that I engage in and discussions I have with participants in the industry.
It's very interesting you mentioned that. I was just reading an article, I think yesterday, where I think it was the Church of England pension fund or something to this effect, kind of singing a similar tune to what you just said there, basically saying we need to commit in more than our personal portfolios here into the mining industry, like kind of making the case for long-term investment. The industry seems to suffer for maybe 10 or 15 years from this kind of short-termism, so to speak. Yes. And there China is, on the other hand, not really with the same paradigm, so to speak. They don't even mind seemingly losing money for a little while if that will help them in the long term. So what does that mean when people want to be more long-term? I mean, are they going to hold on to stocks that are going down? Like, what does it mean?
So it's a very relevant point to discuss, and to the point you make about Chinese investment in the industry. I mean, that has been very much a hallmark of Chinese companies, again, in the last 20 years in particular. And I think in recognition of China becoming a huge consumer of key metals such as iron ore, copper, etc., which really came about, I guess, starting especially in the 1990s and early 2000s, when there was just an enormous increase in the demand for those commodities to fuel development in China. Very early on, I think China recognized that their dependence on metals from within China was never going to be enough to satisfy the demand. So therefore, there was an incentive not only to import huge quantities of, for example, iron ore, but also copper, but also to move abroad in the search for minerals. And, one of the things, again, that I've seen certainly in the last 15 years is this enormous expansion of Chinese companies and acquisition of assets in various parts of the world, perhaps most especially in Africa, but also in South America, for example. And I think that's an indication of their commitment to long-term strategic thinking, not just in terms of acquisition of assets, but commitment to building infrastructure to facilitate development of those assets, for example, which I think with very few exceptions is often one of the barriers to development of so-called stranded assets, and an unwillingness on the part of mining companies themselves and perhaps investors in them to commit to development of infrastructure that would facilitate the development of those resources. That is, I think, starting to be a very important point now, and potentially a change. We've seen recently, obviously, the interest by the US government in investing in rail in Angola, for example, to facilitate export of copper from the DRC and potentially from Zambia. I think it's an illustration of the wake up that's going on now, both with investors and potentially governments as well, of the importance of taking that long-term view and making the commitment to invest. And by the way, that includes investing in exploration through the cycle, not just when commodity prices are high, which is, again, I think one of the frustrations many of us felt in the 80s and 90s with budgets being cut and then ramping back up again. I think, more than the absolute spend on exploration, which I believe is very important, it's the consistency of spend in exploration is really important to provide success.
Now, do you think that then means that we basically have to rely in part on the government to be there when basically investors don't want to be there, right? Because that seems to be what's happening now. Like, why are we getting projects going left, right, and center? Well, the government's decided we had to do this. It sounds like we need the government. I hesitate to say here on a free market mining podcast, but I mean,
Yes.
What do you think?
I would firstly say that I don't believe that governments should be directly involved in exploration. What I think their most important role is facilitating both exploration in terms of provision of basic geological and other data to help explorers make discoveries. By providing infrastructure, I think can be a relevant unlocking of resources and access to resources. And I think in particular, and it's especially relevant now, facilitating permitting for development of discoveries and expansions, because that is often now one of the biggest blockers to development of new resources. In the last 10 years, I think in particular, what we've seen in the industry is a move away from greenfield developments to brownfield expansions. Partly that's a result of very high costs of new greenfield developments, but I would suggest that a large part of that is just the time required now for permitting and development of new greenfield operations.
Okay, so just to clarify then, I assume you've been seeing these news stories with the Pentagon even seeming to invest in mining projects. Let me phrase it this way, are you satisfied with what you're seeing now from governments? Do you think they're doing too much in a sense? Do you think they're doing enough? How would you rate, if you had to, or how would you comment on what you're seeing from, say, for example, the EU, the United States, and maybe Canada, who seem to be working on a similar path here?
Yes, I would describe quite a lot of those developments as maybe not quite knee-jerk reactions, but certainly reactions to some geopolitical concerns that have started to really, I guess, become quite prevalent in the last 5 years. I could name, for example, concerns over rare earth elements, the sourcing of those, and in particular, the processing of those. I could describe the fact that in the lithium industry, for example, 80% of the processing capability for lithium ores is focused in one country, China. And I think there has been quite a wake up in, yes, the EU, I think the US, and latterly perhaps Canada as well, about this concentration of both the mineral supply, but especially the processing capability for those minerals being just too concentrated in one or more jurisdictions. And I think some of the moves that we've seen lately, perhaps including the IRA legislation in the US as well, is an attempt, firstly, to recognize those challenges and also attempt to address them. I would go back to my original point, though, and still suggest that as a free marketeer in the mining industry, I firmly believe that companies should be developing mineral resources, but the role of governments, in my opinion, is to facilitate those developments.
Yeah, like basically you're saying to set the table, so to speak, so that business can run as efficiently as possible, right? Like get out of the way,
Exactly.
but keep it safe, but get
Yeah.
out of the way. Okay, so just in terms of the supply chain, then there's this libido corridor, which you were mentioning, that's going out of Angola. You said you worked in Zimbabwe, and that's where, in fact, you led a team make a discovery of diamonds there. What do you think about what's going on in Africa? I mean, we see what's going on in West Africa with all of these juntas, and there's a sense of, not knowing week in, week out if you're going to have your mining permit. There's, the copper belt. There, even Zimbabwe looks like they want to join the party. And as someone who's worked there, you probably have an idea. And then we have the Libido corridor and the, I think, Tazamar Railway going out to Tanzania on the eastern coast of Africa. So what is your sense of Africa when you see what's going on there?
Well, the first point I'd make is the obvious one, which is there are many different countries in Africa, jurisdictions and types of government, etc. It's an enormously well endowed continent with mineral resources. They vary by region and nature of commodity, etc. But in general, it has huge potential, which I think has not been fully realized. Partly that's been due to lack of investment. Partly, I think it's a product of the fact that infrastructure in particular is limited in some parts of the continent. And for those very well endowed countries, such as the DRC and Zambia, in the case of copper, one of the biggest challenges to further development of production of copper in particular from those jurisdictions is being landlocked and getting access to ports, either on the west coast of Africa, as you're referring to there via, for example, Lobito, or the east coast, Dar es Salaam. I think China has led the charge in terms of developing the infrastructure to facilitate those developments which are now happening. And it's part of that strategic long-term thinking that I think Chinese companies have exhibited over the last 15 to 20 years. There has been a lot of debate about the merits or otherwise of large-scale Chinese investment in mining in Africa. There's been some spectacular successes. I think there's been cases where there's been quite a lot of criticism about the approaches they've taken, etc. Having said all of that, I think, again, Western governments are now waking up to the fact that resources are located where they are located. It's very difficult to change that. And in the case of, for example, cobalt, the reality is, it's a geological reality, the majority of cobalt is concentrated in the DRC. There are a lot of concerns over how that is produced, etc. But there is now, I think, a willingness and a preparedness to intervene in those jurisdictions to provide access to resources, but also to provide perhaps another level of governance that would facilitate better conditions for extraction and development of resources.
And you mentioned offline about Samandu in Guinea. What is your sense of that massive iron ore project? I guess Rio Tinto was involved at one point. I guess they still are. Don't they have like a quarter of the project?
So the first thing I'd say is Simandu is an example of a very large, high-quality resource in Africa that has been essentially stranded for a long time. Rio Tinto first got involved in the late 1990s and has been involved ever since in attempting to bring the project to market. It is undoubtedly the best, highest quality resource of iron ore anywhere. What has hampered its development in particular is its location in a isolated part of Guinea without access to infrastructure, and the scale of investment that's required to allow production on an economic scale is enormous, of the order of $20 billion, of which probably $12 billion will be the final cost of the infrastructure, rail and port, which obviously is required to allow mining of what is a very large resource and a very high quality resource. The relevance of that in the context of the world steel industry at the moment is that being a very high iron content project requires less in terms of emissions to produce steel. So its attraction is not just that it's a very high quality resource, but it's also one that will allow production of steel in a more environmentally friendly way. And that is a big statement in the context of the steel industry being one of the largest emitters of carbon emissions on the planet. So it is a very important development in that regard. The fact that it's taken more than 30 years to come to production is just an illustration of the point I was making earlier, that Africa has some tremendous resources, often in challenging locations, and it requires unlocking either financial assistance to develop those resources or a commitment to development of infrastructure to facilitate development of those resources.
And just on the green metal discussion, of course, that's become a bigger and bigger issue in the last 2, 3, 4 years. Do you think this is going to happen? Do you think we're going to have a green metal price and a non-green metal price? And basically, if you sell a car, you're going to have a little sticker on it, maybe saying this is basically an ESG friendly product. Maybe it's tariffs that will make this happen, where it's, if it's not ESG friendly, we put a tariff on it, or whatever the case might be. What is your sense of this green metal topic? Is it feasible?
First thing I would say is that all of the major mining companies have made commitments to decarbonize, and the goals and the targets that they've set are variable. But I think I am right in saying that all of the major mining companies are committed to decarbonizing their assets. I think in terms of the fundamental question, which is, will greener metals attract premium pricing? That is yet to be fleshed out in sufficient detail to adequately support higher cost production, because I think that is ultimately the implication of going for greener metal. Now, that may change with technological development, but at this stage, I would say the jury is out on whether there is a preparedness on the part of consumers ultimately to pay more for green metal. There are several initiatives that I'm aware of for at least discussion and perhaps implementation of initiatives to produce, as I mentioned, greener steel, for example, through decarbonisation. Also, greener aluminium. And I could quote, for example, Rio Tinto's activities in Quebec, where they use hydropower to generate electricity for smelting. And you know, the initiatives they're taking there are an example of the commitments they are making to greener aluminium. There is also initiatives similar in the copper industry. But I would say it's still early days, Adrian, and I think it's unclear yet how it will come about, where there'll be essentially two-tier pricing and you can buy either a greener car or a less green car, and you'll be paying more for the greener car. That is evolving. I think it may head in that direction, but to me, it's unclear at this stage how far and how fast it will go.
So you were in exploration. We talked about the challenges relating to funding. What about the technical challenges? I mean, Mark Bristow often talks about how all the big copper deposits have more or less been found, and that there is this issue of grade decline. What is your sense of that issue and how to tackle it? How big of a problem is this?
I think it is a real issue. I think it's fair to say, and I would agree with Mark Bristow, that the easier to find deposits have been found. I think grade decline in terms of head grade delivered to processing plants is a defined phenomenon. It's very obvious in the case of, for example, copper production in Chile, that there has been a significant decline in head grade over the last 20 to 30 years. The easier deposits for processing, I think, have been largely found. There are some exceptions to that, and I'll come back to that in a minute, but certainly there is a technical challenge out there which requires a lot of smart thinking to address it. I would go back to the earlier point I made, though, in terms of funding. I think what it requires is, yes, more funding, but more consistent funding over periods of time. It is extremely unusual to make large, for example, copper discoveries in short periods of time. It requires long-term commitment and application of significantly capable technical expertise, not just to find those resources, but to develop them and ultimately, as I referred to permit them and put them into production as well. So I think there is a substantial challenge there. Now, one of the initiatives that is mentioned quite often in the press these days and in discussions is the application of digital technology, and in particular artificial intelligence, to facilitate exploration and more efficient operations. I would certainly suggest that from what I've seen, there is a role for the application of AI in exploration. I would also say, though, straight up, I do not believe it is a silver bullet that will guarantee faster and easier discoveries of better resources. I see it as an important tool in the toolkit to manage, interpret, and deal with data in a more efficient way because of the number crunching capability it has. But I would subscribe to the view that it needs to be used in conjunction with significant technical expertise. And I'm plugging obviously my own background here in terms of professional capability right across the geological and geophysical, geochemical sciences. And I think that is the key combination that's required to really get the value from what I think is a value-adding approach. In the context of mining operations, I think there is certainly a role for application of AI and areas like, for example, predictive maintenance and better utilization of resources through improved recoveries, for example, in copper, is an illustration of how application of broadly digital technologies can improve the performance of mining in the existing operations that the mining industry owns.
Okay, excellent. And just a couple of more questions here as we wrap up. In terms of jurisdiction, is there anywhere that you're excited about right now? I mean, we see Robert Friedland, for example, developing in the United States. There's a little bit of excitement there in the US. There's also Argentina, which some people think maybe is a place that could, be exciting, but there is always skepticism with Argentina. Where are you excited about?
Well, I would certainly point to Africa, as I mentioned, in terms of its resource potential. And, the other example of Robert Friedland's involvement in that is the Kamoa-Kakula operation in the DRC, which has turned out to be probably bigger and better than perhaps even he imagined in terms of its copper development potential. I would rate that part of Central Africa as extremely prospective, and I think the likelihood that there would be more discoveries there is high. I think West Africa, for all its political complications, and there are some, is another area that I would point to as being richly endowed. Unlocking of those, as I mentioned, requires a commitment to infrastructure development. And, we referred to the relevance of, for example, Lobito for accessing the resources of copper in the DRC and Zambia. I would also suggest that, for iron ore, there's a lot of undeveloped potential in countries like Gabon and Congo. And that could be unlocked through development of infrastructure. I think you're right to mention Argentina, which certainly has come on the map in terms of its potential for lithium production, and the likelihood that lithium production there will at least equal the output from Chile over the next 10 to 15 years marks it out as a very attractive jurisdiction. You mentioned some of the challenges of operating in Argentina, and I think it's undoubtedly the case that there has been various political ups and downs there over the last 20 years, which have made conditions more challenging. Having said that, I've been recently party to discussions with various investors in Argentina who are very excited by the prospect of copper developments. Obviously, BHP is one of those with their investment recently there, but also by the enabling fiscal regime that the Argentine government has recently put in place in the form of the RIGI legislation. And I think that will start to really unlock some of the interest by investors in the copper potential of Argentina. It's hard to say where obviously the next new frontier will come, but I would think that between South America and Africa, it's likely that there will be more significant discoveries there, with the caveat that I mentioned about the need for investment to facilitate those developments.
Okay, excellent. And just very quick follow-up on Argentina. Are you familiar with Barrick Gold's Pascua-Lama project? You know, it got a lot of attention about 10 years ago. I think it straddles the border between Argentina and Chile. You know, I haven't heard anybody discuss it, but it kind of went through my mind after Milei was elected and started saying positive things about mining. Do you have any thoughts on that project? Is it dead in the water, or do you just not know?
I would suggest that it is certainly a very high quality resource. As you say, it does straddle the border, which means that there is another, let's say, dimension to facilitating and permitting of that resource. There has been quite a lot of discussion about the relevance of these cross-border projects, and indeed there is legislation in Argentina that allows for and facilitates development of cross-border projects. Interestingly, BHP's interest in the Lundin project, Filo del Sol, is an example of one that will almost certainly require a cross-border cooperation to facilitate its discovery. So I would think it is certainly likely that Pascua-Lama may come back to the table in terms of its scale and attractiveness. And of course, with the gold price over $2,600, I'm sure there are lots of slide rules being used at the moment to look at that project and how its development might be facilitated again.
Okay, excellent. Thank you for that. And a final question. What haven't we discussed here today as we zoom out and look at the big picture?
The first thing I would say is I don't think in my 40 years of working in the industry, I've seen such a range of opportunities that will likely present themselves for the industry over the next 20 years, mostly as a product of its relevance to the energy transition. But not only that, and I would suggest that, yes, there are an enormous number of challenges that the industry has to face up to, but also the scale of opportunity is huge. And in terms of thinking about young people who wanted to get into the industry, for example, I would suggest that the next 20 years will be hugely interesting and attractive as a career opportunity to get into an industry that has the potential to contribute so significantly to the energy transition. And I mean, if you're looking for, meaningful work and a meaningful career, I would find it hard to describe that as anything less than a fantastic opportunity.
Well, it is funny, isn't it? I mean, it's reminiscent of Cameco turning the narrative from Cameco polluting the world with toxic waste to, we are the solution to carbon emissions, right? And I feel like we're
Yes.
seeing a similar thing in the mining industry, where instead of the mining industry being polluters of the earth, in fact, it is just the opposite. We are helping facilitate the move towards a green energy grid and a green transition.
Absolutely. And I think that is a tremendous opportunity for the industry. And I firmly believe that there are opportunities that can be taken, and it just needs the industry to step up to the plate in terms of, as I said, telling its story more consistently and better, and being a more visible contributor to and recognized as a key part of the solution.
Kevin Fox, independent consultant, geologist, ex-Rio Tinto employee with 40 years in the business. Thank you for joining us and sharing your perspective on this week's Northern Miner podcast.
You're very welcome, Adrian. Thank you for the opportunity.
Thank you once again to Kevin Fox for joining us today on the Northern Miner podcast. And thank you, dear listener, for continuing to support this show. I hope you are enjoying it. If you want to help out the podcast, please leave us a review in the Apple Podcast directory, share it with your friends, and until next week, take care.